So now, how do hedge funds do this specific strategy? Well, hedge funds know that the algo gets activated sometimes, and sometimes ICT concepts seem to be the holy grail, and sometimes ICT concepts seem to be just a piece of bullshit. So, if you want to know if ICT concepts will know, you have to ask yourself a question. Understand why you are using a wait 1 second here. Understand why you are using a stop loss. So here, for example, I'm gonna hop out. Imagine you traded ICT concepts. Here you see this sweep of liquidity, and after it you displace down. Then imagine this is on a lower time frame. It gets retraced into an order block, blah blah blah. And imagine you would target, let's say, this lows right here, which is like something like 2022 model, something like this. So if you target here, ask yourself this question: why you're placing a stop loss? You notice that some days price gets fucked, and this is the intention of this mathematical model, which means that you predict that price would get fucked or it wouldn't get fucked. So in this case, it doesn't hit TP, so this would be a losing trade. You would lose 1 hour. But the placement of the stop loss means that if price comes above this point right here, market won't give a shit about this liquidity, and it will target higher liquidity right here. You don't want to catch the whole move up here, because that would be too risky, and that would mean more risk on the table. So what you are doing with this model is benefiting from this stop loss. And as you benefit from this stop loss, you understand that price will get fucked. And what is a stop loss if you think about it? A stop loss in this case on a short position, it's a buy stop, to cancel your order. So when price gets up, it buys it here. Like, you sell it here, and then if price gets here, you buy it here. This is shorting, and the opposite when you long. So if you, for example, run a position which is a stop position, same as a stop loss. Stop loss is a buy stop. So here, this point right here, wait, let me erase this. This point right here would be a buy stop. You're running a buy stop from here. So what if I told you that with 80% chance on any model, if you place another buy stop here above your stop loss, following the narrative of your strategy, which means you understand that, hey, we swept this liquidity right here. If price gets above this, it will get fucked. In fact, if you have some concepts in your mind and you can trade and you place stop losses, you understand that that's the point of invalidation of a trade. That's the intention behind the stop loss. So if your trade gets invalidated here, you launch a buy stop order right here, but you will use a very, very, very small target. What will this be used for? This will be used for because in case of losing this trade, you are going to win this one. And the intention behind this is that this winning trade right here, I will tell you how to set this trade up. This winning trade right here will mitigate this loss, cover broker commissions, cover broker spread. This has already been calculated, and it will cover this trade loss. So I'm going to show you an example of a trade I took on gold with one model of mine. Let's see. Well, I can't be able to find it, but let's imagine that you say, hey, I am an ICT based trader and I trade something like liquidity sweep. Let me see if I find a setup. Casually gold moved pretty clean. Let's find on GU if I see something. Right here. This is the perfect example. So GU here, imagine you hop on the 15-minute. If you see my other stuff, you will understand it. Here on GU, you can see we swept this liquidity right here. Imagine you trade the silver bullet. Silver bullet time window will end at 4. You trade on 1 minute, right? You marked out this high right here, and you trade the market structure shift, fair value gap, whatever you want. So here you get fair value gap. So you place an entry here, and you say, hey, we swept the liquidity right here. So this high would be the highest point of the day. This is AMD pattern. Accumulation, manipulation, distribution. The famous power of 3 by ICT. This is basic stuff from him. You have to learn it before. If not, I will show you how to do this with other concepts, strategies, specifically support and resistance. So now you short from here, and let's imagine this short actually hit a good amount, but let's imagine you target this low right here. This would be a 30-minute low or 1 hour low. So you target this, and you know that, hey, until we come to this low, if price reverses and goes beyond this point, it will give me a slight move up, and that's the narrative behind this. So this is your buy stop for the stop loss, right? So now you will place another order right here, and you will target 0.5R. I recommend you do the 0.5R. I backtested this way. It's better. You cover for broker commission, and I will explain you how. So you place it. You have now the placement of this. I'm going to share you the source. So placement of the stop order. Placement of the stop order must be mechanical, which means you have to know the distances for your entries and distances for your TP. Must be in percentage, because if you do it on pips, depending on the price, pips would be bigger or smaller, and you want to have it in percentage because percentage means proportional. So it's mechanical because it means it's following a proportion, right? Because if British pounds are very expensive compared to euros, then 1 pip on British pounds will be much smaller, right? And the opposite case scenario with whatever pair. So you have to do it on percentage. So now for percentages, on gold, it would be target 0.04%, and on GBP USD and Euro USD, any USD pairs or USD CHF or USD JPY. I have to review this one. I don't know yet. But any USD pairs at the moment, for stock pairs, I will talk about. But for any United States dollar pair, it would be, yes, it would be 0.02, right? And the distance for the entries are, you write down this is already backtested for you, so I will save you a lot of time. So distance for the entries are 0.02% on, no, 0.01%, sorry, on Euro USD, 0.02% on gold, right? So this is what you have to get. This is mechanical, write this down. So now, as we know, this is our invalidation point for our strategy. Any liquidity-based strategy, I will cover support and resistance, because with support and resistance, this slightly changed because of the narrative. The narrative behind liquidity, I will explain further on, but the narrative for liquidity is that a liquidated high or a session high, any liquidity pool you choose, as soon as we get liquidity swept, the high that comes after that liquidity sweep, the highest point, right? So in this time window, which is silver bullet, the highest point is this one. So this means this is considered, I think you know this concept, this is considered as a protected high. So I mark this out. Wait, if I have this here, protected high. So this right here, it's a protected high. So if this high gets broken, probabilities are that price will displace up, looking for more liquidity on the left of the chart or creating new highs. Trending, what we know as market structure shift, however the fuck you wanna call it. So we got this protected high, and we know with our stop loss that if we go further, we will fuck this price level. So we now will take a ruler, mark out 0.01% here, and place our buy stop order with a 0.02 target right here. I am telling you now the target for the target, it's the lowest percentage, which means if you target 0.02, you drag your entry and you take the minimum pip size, that's 0.02. So in this case, it's just 2 pips. But you don't do this because this is also 0.02, but as you see here, it's 3.1 pips. So this is not interesting. We just want the lowest pip amount for the percentage. So we only want, write this down, we only want the lowest pip amount. We only want the lowest pip amount for the percentage we are targeting. So keeping this in mind here, you will take this trade, risking 1%. And now you may ask yourself, yes, but I'm taking here a 1 to 5 trade, and here I told you that it's a 0.5 R. Keep it this way. If you want to backtest something else, do it if you already have a profitable edge, but at the moment you don't have that. So for the profitable edge, it's this way, and this is not like changeable at the moment. So it's 0.5 R, because I do this to count for broker spread, commissions, and I will explain later why and how to do it. The calculation for the commissions, etc. So now we broke out this level. I placed my buy stop here. And as I placed my buy stop, you can see that we get tagged in and we hit TP. Now it's the moment that you say, hey, but here on this trade, I risked 1%. And if I risk 1% on this one, I would be making 0.5%. So if you went to elementary school, you know that 1 minus 0.5 equals 0.5. So it means that you are losing half percentage, right? That's when asymmetrical risk comes into place. So when asymmetrical risk comes into place, right, you are going to use 1% risk, or however the fuck you want to risk, on this first trade, which is your main edge, right? Here you follow all your concepts, all your mechanical concepts, by the way. And the narrative behind this, I repeat myself, it's because some days the algorithm seems to work and give you perfect mechanical entries that work and repeat every day on the course of 10 years. But some days the algorithm seems it's just closed. It's not turned on, it's turned off, right? So in these cases, instead of getting stopped out, we anticipate that the algorithm will fuck us. So as we anticipate this, we got it here, the entry. Ask yourself this question. If 99% of traders are losing money, most of them use stop loss at same level. This is narrative from ICT that market will chase these stop orders, right? These stop losses. If you just set TP where they set stop loss, you will instantly become profitable. This is pure math. If 99% of people is losing 5% a month, and you're just copy trading them but reverse, You do the opposite. If they buy, you sell, and where they place their stop loss, you place your TP, and where they place your TP, you place your stop loss. Eventually, you will be profitable. So as you don't have a copy trading tool that copies unprofitable traders, you are anticipating unprofitable traders. And they will say, yeah, but I trade 1 to 2, 1 to 3, whatever. You can't be profitable with 0.5. Yes, but most traders, even if they don't trade ICT concepts, they are placing their stop losses here. As you can see, in this case, it reversed. Sometimes, maybe, price facts and goes all the way up. We don't know that. So, this case, we made this. And now it's when asymmetrical risk comes into place. If here we are risking 1% and we're losing 1%, here we need to make more than 1% with 0.5 R risk. You may say, well, yeah, but what? So here you're gonna risk 3%. The mathematical formula is risk 3 times more on stop orders than on original position. This is an equation. It's very simple to understand it, the logic behind it. So if you're taking 1% risk or 1R or 0.5 and you're risking 3 times more here, what will be the result? That when you win on this one at this 0.5 R, you are making 1.5% without including spreads and commissions, right? So as you make 1.5%, you're making at the end of the day 0.5% on a losing day on your model. So this is losing day, 0.5%. And on a winning day, you're making, however, your risk to reward is. Now I will tell you something. This will work the best for high stop loss strategies. Strategies with a high amount of stop loss, but high risk to reward. Profitable strategies must be profitable. Even if it's not that profitable, this can make your win rate increase exponentially. Strategy requires, at very least, 1 to 2 targets. Recommendation here, it's 1 to 3, because what you are doing on this is that on the stop loss you're making this is your equity curve. On the stop loss you're making tiny profit, you're making tiny profit, you're making tiny profit, you're making tiny profit, and then suddenly you make 3% because you hit a TP, and it would be something like this, and this would be your equity curve. It would be slightly profit, bam, winning trade. Imagine another winning trade, and now a loss streak. A loss streak doesn't exist, so profitable. This, ignore this. This would be a profitable model equity curve. You can see mine. On the course of 10 years, it moves like this. But what if you are losing here? Your equity curve would be like this. Oh, you won. Oh, you lost. Oh, you won a lot. Oh, now you're losing. Oh, now you won. Oh, now you're losing. Oh, now you won. Oh, now you lose. Now you won. Now you lose. You lose again. Now you won, and you won big. You won 2 times in a row. Now you have a very big loss streak. Now you're winning. Loss streak. Winning. Loss streak. And your equity curve realistically will look something like this. You will never show me an equity curve of a strategy that's not back tested with this, what I just showed you. You will never show me an equity curve here that without the stop order implementation, the mathematical model, because the mathematical behind it is 3 times more risk on stop orders, high probability of the algo not working, which means high probability of this trade winning. The only scenario you are not winning is when market triggers this order and reverses. That's why I have 90% win rate, more or less, something like 85. So 85% of the days, this strategy is winning, which is a huge implementation. because most strategies that are profitable with 2R, win rate is around, over the course of 10 years, win rate is around 40%. So you would increase win rate by 40%, and I proved this. So this is the implementation. If you just follow these rules for your strategy. This is for liquidity-based strategies. Why liquidity-based strategies? Because on liquidity-based strategies, it's very rare that you get used as liquidity, because market won't target liquidity twice. So if you get a liquidity sweep of an important level like this one, because it's this session high, the protected high right here, it's not going to get liquidated, because narrative tells us that, hey, orders are here, a big hedge fund filled their orders here, now market rallies down, retraces, now rise down, right? But you will never get the case, or almost never, the case where you get just slightly swept again and then rally down, right? So that would not be possible. But what if you are a support and resistance trader, which I dislike because it's hard to mechanize for a beginner? I am able to mechanize that process, that thought process behind it. Support and resistance. I can take that, hey, I can take a rule that, hey, 0.02 level, so I take a range of 0.02 with parallel channels right here, and I drag it from every swing low to the infinite, and hey, I found a support level. So if it bounces twice, now I set a limit order right here. I place my stop loss below this one, and hey, so imagine you're trading this concept. Imagine you're trading here. But here, in this case scenario, it worked. If I erase this, if you need something, you rewind back and you watch it again. That's the mathematical model. Summing up, the mathematical model is 3 times risk on a stop position. That goes against your strategy, which means your invalidation point does not get invalidated, and you get slight profit. So when you're trading support and resistance and you've watched ICT, what may happen a lot of time is that market consolidates, there's a huge consolidation, then a sweep of the liquidity, and then a rally down. And imagine you shorted here at this point, then you get stopped out with your stop loss here, and then you get a reversal, right? What you're gonna do in this case scenario, if this is your position with stop positions, there are two types of setups. After liquidity and before liquidity. I will do an in-depth video of the liquidity of my strategy and the model I'm going to show you. Before liquidity and after liquidity. Before liquidity, not any liquidity gets swept. You are running the risk of you being used as the liquidity. In this case, it's very obvious. You can make money with support and resistance trading, but hey, suddenly, bam, you get used as liquidity. Bam, here, you got used as liquidity. Bam, here, liquidity. Here, you may say, oh yeah, but here I have an edge now, bam, liquidity. Here, both this time, bam, liquidity. Bam, liquidity. Bam, liquidity. See? Even if this took out already all these orders. So in this case, your stop position will be before your stop loss being tagged. Because the only losing trades on this, there are two types of losing trades. Two types on losing trades. Either breakout or either liquidity sweep. I won't argue with anyone. Two only possible scenarios. A breakout. What does a breakout mean? A resistance gets broken and market continues its trend. Just fucking this level. If market decides, that's why here, imagine you place your stop loss. Here as well, your stop loss must be mechanically set with a fixed percentage. Of course, you're gonna say, okay, 0.02 above the high. So you place it something like this, 0.02, right? Just in case, spread or whatever you get used as liquidity or whatever you want. And your stop order would be before your stop loss getting hit, because you're running the risk that, hey, we sweep your stop loss and then go down. So your stop order can't be this high, because it would need to target this high right here, and maybe price won't come all the way up there. So you're going to set your stop order a fixed percentage before stop loss. I would recommend 0.01 for GBP USD and 0.02 for gold. You're gonna target here. You're gonna use 0.01 below, and you will target 0.01 after this stop loss. So this would be your trade. You target here and the stop loss of the stop order. Now we are going to call, to make it easier to understand, the trade of your strategy. It's trade 1, and the stop order will be trade 2, right? So this is your trade. So in this case, if you get the breakout, bam, stop order gets triggered. Remember, this is 3% risk, and this is 1.5% gain. This is 1% gain, and this is 3. This is 1% loss. This is 3% win, or whatever, or 3%, 2%, 10%, whatever your risk to reward is. So before getting the stop loss triggered, if you get used as liquidity, price will not go exactly to the peep to the stop loss and then reverse. Usually it will take out slightly your stop loss, because 8,100 million people use the same fucking stop loss as you. You're just a little fish, and then price drops. So in this case, if you can see here, stop order gets triggered, and then we get a profit of 1.5%. Only case scenario we are losing is this one. As I showed you with proven backtested data, this happens and wins 90% of the times, which means only 10% of the time price will trigger this stop order, trigger this stop loss, and then go down and then do this. Trigger the stop order, stop out this trade, then stop out the second trade. Very rare to happen this. So this is for if you're a support and resistance trader. Hard to mechanize. I don't recommend this. I recommend you to base your strategies on liquidity. I will make more videos about liquidity based strategies. How can you use them? They are harder to understand, they are complex, but hey, trading is not easy, and you have to put a lot of effort to just know where the liquidity is and mechanize your thought process. So this would be the stop order and mathematical model. Remember, second trade gets 3 times more risk on the table than first trade. 3 times 1 in this case. Let's call A and B. This one is A and this one is B. So B, this is risk, equals 3 times risk of A. If you risk 1%, which is recommendable based on your drawdown stats, but usually if you have a profitable model, you can allow yourself to risk 1%, even maybe 0.75%. You will then do the math and take this here. This won't take you screen time because it's automatic. Stop order triggers itself, it's automatic. Either win, either a loss. And on the liquidity type of level, it's the same. So this would be all. I see you in the next one.